In the cryptic world of blockchain, one name stands above all: Satoshi Nakamoto. Imagine a world where trust is decentralized, where power is no longer in the hands of a few. This is the world that Satoshi Nakamoto envisioned when he introduced Bitcoin to the world in 2008. A pseudonym used by a person or possibly even a group of people, Satoshi Nakamoto is the name that stirs up mystery and intrigue in the realm of digital currency. Satoshi Nakamoto, the architect behind the world's first decentralized cryptocurrency, Bitcoin, first appeared on the scene when a white paper titled Bitcoin, a peer-to-peer electronic cash system, was published on a cryptography mailing list. This was not just an introduction to a new form of currency, it was a radical shift in our understanding of what money could be. It was a blueprint for a financial revolution. The year 2008 witnessed the financial world at the brink of collapse. Amid the chaos, a white paper emerged promising a new financial order. This was no ordinary document. It was the birth of an idea that would shake the world, an idea that would soon become synonymous with freedom, self-sovereignty, and of course, mystery. That idea was Bitcoin. In October of that tumultuous year, an individual or a group of individuals known as Satoshi Nakamoto published the Bitcoin white paper titled Bitcoin, a peer-to-peer electronic cash system. This 9-page document was more than just a theoretical proposal. It was a blueprint for a financial revolution. The white paper outlined a system where transactions could be conducted directly between parties without the need for a central authority, such as a bank or government. Instead, these transactions would be recorded on a public ledger known as the blockchain, secured by a network of computers called nodes. This was a radical departure from the traditional financial system, which relied on centralized institutions to verify and record transactions. The white paper also introduced the concept of mining, a process where transactions are verified and added to the blockchain. In return for this service, miners are rewarded with newly minted Bitcoin, providing a self-sustaining and self-regulating system. But the brilliance of Bitcoin wasn't just in its technological innovation, it was a response to the financial crisis, a solution to the problem of trust in central institutions that had faltered and failed. It was a new form of money, immune to inflation, free from government control, and accessible to anyone with an internet connection. The impact of this white paper was profound. It sparked a wave of innovation and ignited a new industry, the cryptocurrency industry, now worth trillions of dollars. It inspired a generation of developers, entrepreneurs, and dreamers who saw in Bitcoin a way to reshape the world. This groundbreaking concept, the brainchild of Satoshi Nakamoto, would forever change the financial landscape. In 2010, as quickly as he had appeared, Satoshi Nakamoto vanished from the virtual world. Just like that, the mysterious creator of Bitcoin stepped back into the shadows, leaving behind a revolution that would forever alter the course of financial history. Satoshi's abrupt departure triggered a whirlwind of speculation among the burgeoning crypto community. He'd been an active participant in online forums, often engaging in discussions about the potential and future of Bitcoin. Then suddenly his digital voice fell silent. The forums that once buzzed with his insights and clarifications went quiet. It was as if he had flicked a switch, and Satoshi Nakamoto, the enigmatic architect of a new financial era, was gone. This sudden silence only intensified the intrigue that had always surrounded him. Every new message, every post, every email from Satoshi had been scrutinized, dissected, and analyzed in an attempt to unmask the man behind the pseudonym. But his disappearance made the mystery all the more tantalizing. The last known communication from Satoshi came in the form of an email to a fellow developer. In it, he stated that he had moved on to other things, fueling intense speculation about his identity and motives. Was he a solitary genius who had completed his magnum opus and retreated from the spotlight? Or was he part of a larger group that had decided to step back for reasons unknown? Theories abounded. Some suggested he was lying low to avoid legal trouble, while others speculated that he might have passed away. The more imaginative conjectures pointed to shadowy government agencies or think tanks. But there were no definitive answers, no solid leads. The man, or perhaps the group of people known as Satoshi Nakamoto, had disappeared as mysteriously as they had appeared. His abrupt departure didn't halt the momentum of Bitcoin. On the contrary, it seemed to have a galvanizing effect. The community rallied, developers stepped up, and Bitcoin continued its march towards becoming a world-changing phenomenon. His sudden silence only deepened the mystery surrounding his identity. But it also solidified his legacy as a revolutionary visionary whose creation continues to challenge the traditional notions of money and finance. The enigma of Satoshi Nakamoto sparked a global manhunt, with numerous individuals claiming to be the elusive creator of Bitcoin. In a world where fame is often sought after, it is no surprise that many have stepped forward, asserting that they are the mysterious mastermind behind the revolutionary cryptocurrency. Take Craig Wright, for instance, an Australian computer scientist and businessman. He claimed to be Satoshi in 2016 and even went so far as to provide proof in the form of early Bitcoin keys. But experts quickly debunked his claims, asserting that the evidence was not only insufficient, but also possibly manipulated. Wright's claim to the throne of Satoshi has been met with widespread skepticism, and many consider it nothing more than a publicity stunt. Then there's Dorian Nakamoto, a Japanese-American man living in California, who was pointed out by Newsweek in 2014. His birth name, Satoshi Nakamoto, his background in physics and systems engineering, and his private, humble lifestyle led some to believe that he was the Bitcoin creator. But Dorian denied any involvement, stating he had never even heard of Bitcoin until the Newsweek article. His claim was backed by the real Satoshi, who came out of digital hiding to deny being Dorian. There have been countless others, from tech entrepreneurs to cryptographers, who have either claimed to be Satoshi or have been suspected of being so. However, each claim has been met with the same result: a lack of conclusive, irrefutable evidence. The hunt for Satoshi has become a modern-day quest for the Holy Grail, an enigma wrapped in layers of digital codes and pseudonyms. It's a journey through a maze of cryptography, secrecy, and speculation. But despite the numerous attempts to unmask the creator of Bitcoin, no one has yet been able to provide definitive proof. Despite the numerous claims, the true identity of Satoshi remains shrouded in mystery. The hunt continues, and the question remains: who is Satoshi Nakamoto? As the hunt for Satoshi continues, numerous theories have emerged, each more intriguing than the last. Let's dive into some of these theories and try to unravel the enigma that is Satoshi Nakamoto. The first theory, and perhaps the most popular, is that Satoshi Nakamoto is not a single individual, but a group of people. This hypothesis stems from the sheer brilliance and complexity of Bitcoin's design, leading many to believe that it was a collective effort. However, as captivating as this theory might be, there's no substantial evidence to back it up. Moving on, another fascinating theory suggests that Satoshi could be a government agency. Some argue that the cryptic nature of Bitcoin and its potential for disruption aligns with the tactics of an intelligence agency. Yet, this theory also lacks concrete proof and is largely based on speculation. Then there's the theory that Satoshi Nakamoto could be an advanced artificial intelligence. It's a theory that seems right out of a science fiction novel, but it's not entirely dismissed. The argument is that the creation of Bitcoin, a system so ahead of its time, could only be the work of an AI. However, like the other theories, this one too is more conjecture than fact. There's also the theory that Satoshi could be one of the well-known personalities in the tech world, such as Nick Szabo, Dorian Nakamoto, or even Elon Musk. However, these personalities have either denied these claims or haven't been able to provide conclusive evidence of being Satoshi. In the end, these theories, as fascinating as they are, lack the one thing they need the most: proof. They are born out of curiosity, speculation, and at times a desire for sensationalism. But they do serve a purpose. They keep the conversation going, they keep the mystery alive, and they keep us all intrigued. Theories abound, but the truth remains elusive. While his identity remains a mystery, Satoshi Nakamoto's impact is undeniable. The legacy of Satoshi Nakamoto, the enigmatic creator of Bitcoin, extends far beyond the birth of a single cryptocurrency. His revolutionary idea has sparked an entire industry, pushing the boundaries of what we thought was possible in the realm of finance and technology. Satoshi's vision of a decentralized, peer-to-peer electronic cash system has given rise to an entirely new asset class. Today, there are thousands of cryptocurrencies, each with their unique features, but all owing their existence to the trail blazed by Bitcoin. From Ethereum's smart contracts to the privacy-centric Monero, these digital assets have reshaped the way we think about money and value. But Satoshi's influence doesn't stop at cryptocurrencies. His use of blockchain technology, a distributed ledger system that underpins Bitcoin, has found applications in a myriad of fields. From supply chain management to voting systems, blockchain technology promises to provide transparency, security, and efficiency. And all these innovations trace their roots back to Satoshi's original white paper. Perhaps even more profound is the philosophical shift Satoshi's work has inspired. The idea of decentralization, of wresting control from central authorities and placing it in the hands of individuals, is a powerful one. It's a concept that has inspired countless innovators, thinkers, and dreamers. It has sparked movements and debates about privacy, sovereignty, and the very nature of power itself. In many ways, Satoshi Nakamoto has become a symbol, an idea. He represents the power of innovation, the potential of technology to disrupt established systems, and the dream of a more equitable and decentralized world. So while we may never know the true identity of Satoshi Nakamoto, his legacy is clear. His ideas have changed the world, sparking a financial revolution and inspiring a generation of innovators. In the end, perhaps it's not who Satoshi Nakamoto is, but what he represents that truly matters. As we journey through the saga of Satoshi Nakamoto, we find ourselves entangled in a web of intrigue and speculation. In the attempt to unravel the enigma of Satoshi Nakamoto, we've traversed a landscape populated by innovators, cryptographers, and mavericks. We've delved into the birth of Bitcoin, the world's first decentralized cryptocurrency, and the subsequent disappearance of its enigmatic creator. Some believe that Satoshi is an individual, a genius who single-handedly revolutionized the financial world. Others speculate that Satoshi is not one, but a group of brilliant minds. Theories range from the plausible to the downright fantastical. There are those who believe Satoshi is a time traveler, a government agency, or even an advanced artificial intelligence. Yet the more we delve into the mystery, the further the truth seems to slip away. Each theory brings with it a host of questions, and for every answer we find, two more questions arise. It's as if the mystery of Satoshi Nakamoto is a puzzle that, the more pieces you find, the bigger it gets. This enduring mystery continues to captivate the crypto world. It fuels debates, inspires research, and sparks creativity. The question of Satoshi's identity is more than just a curiosity. It's a symbol of the revolutionary spirit that drives the crypto world. It's a reminder that in an era where privacy is increasingly rare, anonymity can still be maintained. The mystery of Satoshi Nakamoto serves as a testament to the power of ideas. Whether a single person or a group, Satoshi's vision has sparked a revolution that continues to change the world. It's proof that ideas, once set in motion, can take on a life of their own, shaping and reshaping the world in ways unimaginable. The identity of Satoshi Nakamoto remains one of the greatest mysteries of the digital age, a testament to the enduring allure of the unknown. Have you ever wondered what Bitcoin is? Well, let's dive right in then. Bitcoin, often abbreviated to BTC, is a type of digital currency, also known as cryptocurrency. Unlike traditional money, Bitcoin isn't printed or minted. It's created and held electronically with no one central authority overseeing its distribution or value. The concept of Bitcoin was born in 2009, introduced to the world by an anonymous entity known as Satoshi Nakamoto. Whether Satoshi is a person, a group of people, or a highly intelligent chimp with a knack for cryptography, we still don't know. But what we do know is that Satoshi's introduction of Bitcoin marked the beginning of a new era in financial technology. So what sets Bitcoin apart from traditional currencies? Well, for starters, Bitcoin is decentralized. This means that it's not controlled by any government, financial institution, or central authority. It operates on a technology called blockchain, a type of distributed ledger enforced by a disparate network of computers. Bitcoin is created or mined through a complex process where powerful computers compete to solve mathematical problems. The miner who solves the problem first gets to add the next block to the blockchain and is rewarded with a certain amount of new Bitcoins. And here's something interesting. The total number of Bitcoins that will ever exist is capped at 21 million. As of today, over 18 million have already been mined. This scarcity is one of the reasons why Bitcoin has value. Another unique aspect of Bitcoin is its pseudonymity. While all Bitcoin transactions are publicly recorded on the blockchain, the identities of the people involved are obscured, providing a level of privacy. By now you might be wondering, but how does this Bitcoin work? Well, stick around, because in the next scene we're going to explore the logic behind Bitcoin and how it's changing the way we think about money. Bitcoin, unlike traditional currencies, operates on a technology called blockchain. Now you might be asking, what is a blockchain? Think of it as a decentralized public ledger, a record book that's available to everyone and controlled by no one. This ledger includes all confirmed transactions, making it a transparent and trustless system. You see, when a Bitcoin transaction is made, it's like writing a line in this ledger. But it's not as simple as jotting down numbers in a book. This transaction must be confirmed by a network of computers or nodes, which work to validate and record the transaction on the blockchain. This process is known as mining, and it's not about pickaxes and hard hats. In the world of Bitcoin, mining is the act of validating these transactions. Miners, or the people who own these computers, solve complex mathematical problems to confirm transactions. Once a problem is solved, the transaction is added to the blockchain. As a reward, the miner receives new bitcoins, thereby introducing more of the currency into the system. Now, you might be wondering, can we just keep mining and get an unlimited amount of bitcoins? Well, no. Here's where the value of Bitcoin comes into play. Unlike traditional currencies that can be issued without limit, there will only ever be 21 million bitcoins. That's right, only 21 million. This scarcity is one of the reasons why Bitcoin has value. You see, the rate of new bitcoins entering the system is regulated and slows down over time. This event, known as halving, happens every 4 years approximately. It's like a digital gold rush where the gold becomes harder and harder to find. The last Bitcoin is expected to be mined around the year 2140. So what does this all mean? It means that Bitcoin operates on a unique logic. It's a currency that's not controlled by any government or organization. Its value is derived from its scarcity and the work required to mine it. It's transparent, with every transaction recorded on a public ledger. And it's trustless, meaning you don't need to trust a bank or government to know that your Bitcoins are safe. But it's not without its challenges. The mining process uses a lot of energy, and the value of Bitcoin can be highly volatile. Yet despite these challenges, Bitcoin has become a key player in the world of digital currencies. So that's the logic behind Bitcoin. But what does the future hold for this digital currency? The future of Bitcoin is a topic of intense debate among financial and tech experts. Bitcoin, the world's first cryptocurrency, has had an impressive run since its inception in 2009. As we look towards the future, the potential for Bitcoin's growth is a tantalizing prospect. Looking at Bitcoin's past performance, it's hard not to be optimistic. From being worth virtually nothing in its early days, to reaching an all-time high of nearly $65,000 in April 2021, Bitcoin's meteoric rise has been nothing short of spectacular. This growth, though marked by volatility, demonstrates the potential for significant returns on investment. But it's not just about the numbers. Bitcoin's underlying blockchain technology offers a decentralized and secure method of transferring value, making it attractive for a range of potential future use cases. For instance, Bitcoin could revolutionize international money transfers, offering a quicker, cheaper, and more reliable method than traditional banking systems. Furthermore, Bitcoin's potential as a hedge against inflation cannot be overlooked. With central banks around the world printing money at unprecedented rates, many investors are turning to Bitcoin as a digital gold. In a future marked by potential economic instability, Bitcoin's fixed supply could make it a safe haven asset. However, the future of Bitcoin isn't without potential challenges. One of the biggest hurdles could be regulatory issues. Governments around the world are grappling with how to regulate cryptocurrencies. Overly strict regulations could stifle innovation and limit the potential growth of Bitcoin. Moreover, competition from other cryptocurrencies is another factor to consider. Bitcoin may have been the first, but it's not the only player in the game. There are thousands of other cryptocurrencies out there, many of which offer unique features and advantages. If one of these rivals were to gain significant traction, it could potentially threaten Bitcoin's dominance. Then there's the question of adoption. For Bitcoin to truly reach its potential, it needs to be widely accepted for everyday transactions. While we've seen some progress in this area, there's still a long way to go. In conclusion, the future of Bitcoin is a complex and multifaceted issue. There's no denying the potential for growth, but there are also significant challenges that need to be overcome. The road ahead may be uncertain, but one thing's for sure. Bitcoin has already made its mark on the world, and it's not going anywhere anytime soon. No one can predict the future with certainty, but Bitcoin certainly promises to be an exciting space to watch. Interested in becoming a part of the Bitcoin story? Here's what you need to know about investing in Bitcoin. First off, let's talk about how to buy Bitcoin. It's not like strolling into a bank and asking for a bar of gold. No, it's digital. To buy Bitcoin, you'll need to go online to a cryptocurrency exchange. Think of it as a digital marketplace where you can trade your hard-earned dollars or euros or yen for Bitcoin. There are numerous exchanges out there like Coinbase, Binance, and Kraken, to name a few. Choose one that suits your needs, sign up, and you're ready to buy Bitcoin. But wait, where will you store your shiny new Bitcoin? In a digital wallet, of course. This isn't a physical wallet that you can lose or get stolen. It's a secure digital space where your Bitcoin lives. There are different types of digital wallets: online wallets, mobile wallets, desktop wallets, and even hardware wallets. Each has its own pros and cons, so be sure to do your homework and pick the one that's right for you. Now let's address the elephant in the room: risk. Bitcoin, like all investments, carries risk. And in the case of Bitcoin, the risk is amplified by its notorious volatility. One day, the price is soaring. The next, it could plummet. This isn't for the faint of heart. But as the saying goes, no risk, no reward. Speaking of which, it's important to remember, don't invest more than you can afford to lose. And don't just take my word for it. Do your own research. Understand what you're getting into. Read up on Bitcoin, learn about its history, its technology, its potential future. Only then, armed with knowledge, can you make an informed decision about investing in Bitcoin. Remember, investing in Bitcoin, like any investment, should be a calculated decision. So there you have it. That's Bitcoin in a nutshell. We've taken a journey from its basic definition, a decentralized digital currency, through the logic underpinning it, blockchain technology, and cryptographic principles, right up to its potential future as a mainstream currency. Throughout, we've seen the revolutionary aspects of Bitcoin, how it's not just a coin, but an entirely new way to think about and handle money. We've also delved into the rewards and risks associated with investing in Bitcoin. The potential for high returns is there, but so are the risks, given the volatile nature of cryptocurrency markets. As with any investment, it's wise to do your due diligence and never invest more than you can afford to lose. Whether Bitcoin is a passing fad or the future of money, only time will tell. But one thing is for sure, it has definitely revolutionized the way we think about money and financial transactions. Ever wondered what an altcoin is? Well, strap in, folks, because we're about to embark on a journey into the wild and wondrous world of cryptocurrency. You see, it all started with the rise of a digital phenomenon that we now know as cryptocurrency. It's a term that has been tossed around a lot in recent years, causing a fair share of furrowed brows and intrigued whispers. Cryptocurrency ignited a spark in the financial world, igniting a wildfire of interest. People from all walks of life, from tech enthusiasts to everyday folks, have found themselves drawn to the allure of this digital gold rush. At the heart of this intrigue lies Bitcoin, the first and most famous of these digital currencies. But while Bitcoin might be the face of cryptocurrency, it's certainly not the only player in the game. This is where the term altcoin comes into play. Altcoin is a blend of two words, alternative and coin. It's a term that has been coined, pun absolutely intended, to refer to any cryptocurrency that isn't Bitcoin. It's the alternative to the coin that started it all. You see, while Bitcoin was the pioneer, the success it enjoyed opened up the floodgates for a slew of other digital currencies to enter the market. And these, my friends, are what we call altcoins. Altcoins might be the new kids on the block, but they're certainly not to be underestimated. They've been making waves in the crypto world, offering a plethora of options for those looking to dabble in the digital currency market. Each altcoin comes with its own unique features, benefits, and potential pitfalls, making the world of cryptocurrency a vibrant and dynamic landscape. But what exactly are these altcoins? How do they work? What's the logic behind them? And most importantly, what does the future hold for them? Well, all these questions and more will be answered as we delve deeper into the fascinating world of altcoins. So let's dive in to find out what exactly is this altcoin. So, what is an altcoin? You've probably heard this term tossed around in conversations about cryptocurrency, but what does it truly mean? Well, let's break it down. The term altcoin is a portmanteau, a blend of two words, alternative and coin. In the simplest terms, an altcoin is any digital cryptocurrency similar to Bitcoin. That's right, Bitcoin isn't the only player in the game. In fact, there are thousands of these alternative coins out there, each with its own unique features and purposes. Now, why alternative, you may ask? The answer lies in the very reason these altcoins were created. Bitcoin, as the first ever cryptocurrency, set the stage and defined the basic framework for all cryptocurrencies. However, it also has its limitations. And this is where altcoins come in. They were developed as alternatives to Bitcoin. designed to improve upon or offer something different from what Bitcoin provides. Some altcoins are variations on Bitcoin's open-source protocol, with changes in underlying algorithms or other features. Others are built from scratch, with entirely different protocols and cryptographic algorithms. This gives each altcoin its unique angle, be it faster transactions, greater privacy, smart contract functionality, or something else entirely. As you can see, the world of altcoins is vast and varied. From Ethereum to Litecoin, Ripple to Cardano, each altcoin offers a different perspective on the concept of digital currency. These altcoins are not just copies or clones of Bitcoin, they are innovative solutions, pushing the boundaries of what's possible in the realm of digital finance. But let's not forget, while they may be alternatives, altcoins are not necessarily rivals to Bitcoin. They are more like companions on the journey, each contributing in its own way to the evolution of the cryptocurrency ecosystem. In other words, altcoins are the alternatives to Bitcoin. They represent the diversity and innovation in the ever-expanding universe of cryptocurrency. So next time when you hear the term altcoin, remember, it's not just about being an alternative to Bitcoin. It's about the potential for change, the scope for innovation, and the promise of a future where finance is decentralized, secure, and accessible to all. Now that we know what an altcoin is, what's the logic behind it? The logic behind altcoins, much like Bitcoin, is grounded in the innovative technology of blockchain. This is a decentralized digital ledger that records all transactions made with a particular cryptocurrency. It's like a public record of who owns what and who transacts what, providing a level of transparency and security that traditional banking systems struggle to match. So, altcoins operate on a peer-to-peer system, just like Bitcoin. This means that transactions occur directly between users without an intermediary, like a bank or a government. It's a system that's built on trust and verification, where every transaction is recorded on the blockchain, visible to all, and cannot be altered or deleted. But altcoins aren't just Bitcoin clones. They're designed to improve upon or diversify from Bitcoin's protocol. Some offer faster transaction times, some offer greater privacy, and others provide a completely different utility, like smart contracts or tokenization of real-world assets. For instance, Ethereum, one of the most well-known altcoins, introduced the concept of smart contracts, which are self-executing contracts with the terms directly written into code. This innovation opened up a whole new world of possibilities, from decentralized finance to the tokenization of art and real estate. In essence, the logic behind altcoins is all about offering alternatives, hence the name. They provide alternatives to traditional financial systems, presenting a new decentralized way of transferring and storing value. They also offer alternatives within the crypto space itself, each with their own unique features and uses that differentiate them from Bitcoin and from each other. This is why it's crucial to understand that altcoins are not just digital currencies. They represent a wide array of technologies, each with their own purpose, whether it's to facilitate faster payments, provide a platform for decentralized applications, or create a more private and secure internet. Altcoins, then, are not just digital currencies, but technologies in their own right. You might be surprised to learn that there are different types of altcoins. Firstly, let's talk about mining-based cryptocurrencies. Just like Bitcoin, these are altcoins that are generated through a process known as mining. This involves using computer processing power to solve complex mathematical problems. Once these problems are solved, the miner is rewarded with the altcoin. An example of a mining-based cryptocurrency is Litecoin, which operates similarly to Bitcoin, but with a few key differences. Next, we have stablecoins. As the name suggests, these are designed to be stable and are often pegged to a specific value. Most commonly, they're tied to the value of a traditional fiat currency, like the US dollar. This means that unlike Bitcoin and many other cryptocurrencies, the value of a stablecoin doesn't fluctuate wildly. Rather, it stays steady, providing a sense of security and stability. Tether and USD Coin are two of the most popular stablecoins out there, and then there are tokens. These are a little bit different from the other types of altcoins we've discussed. Tokens are not standalone cryptocurrencies. Instead, they are issued on existing blockchain platforms. Tokens can represent a wide range of assets and values. For example, some tokens represent voting rights within a blockchain ecosystem, while others might represent a physical asset like real estate. A popular example of a token is the Binance coin, which can be used to pay for fees on the Binance cryptocurrency exchange. Each type of altcoin, whether it's a mining-based cryptocurrency, a stablecoin, or a token, functions differently and is used for different purposes. Mining-based cryptocurrencies are often used for transactions. Stablecoins are used to hedge against the volatility of other cryptocurrencies, and tokens can be used to interact with specific blockchain ecosystems. Each type of altcoin has its own unique features and uses. What does the future hold for altcoins? As we delve deeper into the digital age, the future of altcoins appears brighter than ever. These digital assets, once considered the underdogs of the cryptocurrency world, are now gaining momentum and acceptance at an unprecedented rate. The increasing popularity of altcoins is largely driven by their potential to solve real-world problems. They offer innovative solutions that extend beyond the capabilities of traditional financial systems, from enhancing privacy and security to streamlining transactions and even fostering social good. Altcoins are proving they have much to offer. But let's not forget, the world of cryptocurrencies is as dynamic as it is unpredictable. The same factors that drive their popularity can also pose significant challenges. Regulatory scrutiny, technological hurdles, market volatility, these are all part of the package. For example, while the promise of enhanced privacy attracts many users, it also raises concerns among regulators, potentially leading to stricter regulations that could hinder the growth of certain altcoins. Moreover, the technological complexity that underlies these digital currencies is both a boon and a bane. It's the engine that powers their innovative capabilities, but it's also a barrier for many who find it hard to understand or trust. This is an area where altcoins will need to work on, making their technology accessible and comprehensible to the masses. Market volatility is another challenge. The value of altcoins can fluctuate wildly, often driven by speculation rather than inherent value. This makes them a risky investment, and that risk may deter some potential users and investors. But despite these challenges, the future of altcoins is far from bleak. They are a testament to the innovative spirit of our times, constantly evolving and adapting to overcome obstacles. With every challenge they face, altcoins seem to come back stronger, more refined, and more ready to change the world. So what does the future hold for altcoins? It's a future of potential, of innovation, of challenges to be overcome and opportunities to be seized. But it's also a future of uncertainty, where the only constant is change. The future of altcoins, like much in the digital world, is full of potential but also uncertainty. What role do altcoins play in the broader cryptocurrency market? Altcoins, short for alternative coins, play a significant role in the cryptocurrency market, beyond just being an alternative to Bitcoin. They serve as a diversifying force, offering investors a wide spectrum of options to choose from, based on their unique features, use cases, and potential return on investment. Just as in traditional finance, diversification is crucial in the crypto world. Altcoins provide a way for investors to spread their investments across a range of assets, reducing the risk that comes with putting all their eggs in one basket. This is especially pertinent in the volatile world of cryptocurrencies, where prices can fluctuate wildly in a short span of time. Furthermore, altcoins provide competition to Bitcoin, the first and most well-known cryptocurrency. While Bitcoin certainly paved the way, it's not without its flaws. Many altcoins aim to improve upon the limitations of Bitcoin, whether that's transaction speed, energy efficiency, privacy, or scalability. This competition pushes for continual innovation and improvement within the crypto sector, which is beneficial for all participants in the market. Some altcoins also cater to specific niche markets or purposes. For instance, there are altcoins that focus on smart contracts, decentralized finance, or digital identity verification. These specialized altcoins have the potential to disrupt various industries, from finance to supply chain management, and even the legal sector. Altcoins also play a significant role in the liquidity of the crypto market. With their lower price points compared to Bitcoin, they allow more participants to enter the market, thereby increasing overall market liquidity. This increased liquidity can lead to more stable prices and less susceptibility to market manipulation. In summary, altcoins play a vital role in the cryptocurrency market. They offer diversification, foster competition, cater to niche markets, and increase market liquidity. They're not just alternative coins to Bitcoin, but key contributors to the growth and dynamism of the cryptocurrency market. Altcoins, then, are key players in the dynamic world of cryptocurrency. Let's recap what we've learned about altcoins. Altcoins, short for alternative coins, are essentially all cryptocurrencies that aren't Bitcoin. They emerged as alternatives, or rather, enhancements to Bitcoin, offering various tweaks and improvements over the original cryptocurrency. Some of these improvements include faster transaction times, increased privacy features, and different consensus mechanisms. The logic behind altcoins is simple yet revolutionary. They operate on the principle of decentralization, much like Bitcoin. This means that no single entity or authority has control over the entire network. Instead, control is distributed among a network of computers, or nodes, which work together to validate transactions and maintain the blockchain. This decentralization is what gives cryptocurrencies, including altcoins, their unique appeal. It represents a shift away from traditional centralized financial systems, offering a new level of freedom and autonomy for users. There are numerous types of altcoins out there, each with its own unique features and benefits. Some of the most common types include mining-based altcoins, stablecoins, and utility tokens. Mining-based altcoins are mined similarly to Bitcoin through a process that involves solving complex mathematical problems. Stablecoins, on the other hand, are designed to have a stable value and are often pegged to traditional assets like the US dollar or gold. And then we have utility tokens, which provide users with access to a product or service. But what does the future hold for altcoins? Well, while no one can say for certain, there's a lot of speculation and excitement surrounding the potential of these digital assets. Some believe that altcoins could play a significant role in the future of finance, providing a more efficient, transparent, and inclusive financial system. Others see potential in specific altcoins for disrupting various industries, from healthcare to real estate, through blockchain technology. Finally, we discussed the role of altcoins in the cryptocurrency market. Altcoins not only add diversity to the crypto market, but also foster competition, driving innovation in the space. They offer investors a wider range of options to choose from, each with its own risk and reward profile. And with thousands of altcoins currently in circulation, they make up a significant portion of the total cryptocurrency market. In conclusion, altcoins represent a fascinating and dynamic aspect of the cryptocurrency world. They offer a glimpse into the potential of blockchain technology beyond just Bitcoin. They are a testament to the ingenuity and ambition of the crypto community, always pushing boundaries, always innovating. And with the world of cryptocurrency ever evolving, who knows what exciting developments await in the realm of altcoins?
Have you ever found yourself pondering over the notion of DeFi or decentralized finance? Or perhaps you've been curious about the logic behind altcoins? Well, sit back and relax, because we're about to embark on a journey to explore these intriguing concepts. DeFi, or decentralized finance, is the buzzword of the day, revolutionizing the traditional financial systems. It's the blockchain's answer to the question, can we create a financial system that's open to everyone and isn't controlled by any central authority? The answer is a resounding yes. DeFi is that revolutionary concept that aims to democratize finance by removing the middleman from the equation. It's like having a bank in your pocket, but without the bank. Now let's turn our attention to altcoins. If you imagine the cryptocurrency world as a vast ocean, then Bitcoin would be the great white shark, the most recognized and dominant species. But this ocean is filled with other creatures too, referred to as altcoins or alternative coins. These are all the cryptocurrencies that aren't Bitcoin. They follow the same basic principles, but often have unique features or uses that differentiate them from Bitcoin. Ethereum, Ripple, and Litecoin are some examples of altcoins. But what is the logic behind these altcoins? Well, it's simple. They provide the diversity and options that Bitcoin can't. Just like different currencies are used for different purposes in the traditional finance world, altcoins serve various needs in the crypto universe. Some are better for quick transactions, others provide more privacy, and some even have smart contract functionality, like Ethereum. Moving on, let's delve into the future of DeFi. With a market size already in the billions, DeFi is set to become a significant player in the global economy. It promises more accessibility, more inclusivity, and more transparency. However, like any innovative technology, it's not without its challenges. It's a field that's still evolving, dealing with issues of scalability, security, and regulation. But the possibilities are endless, and the potential benefits are too significant to ignore. Finally, we touch upon DeFi exchanges. These are platforms where you can trade or lend your cryptocurrencies in a decentralized manner. Think of them as the stock exchanges of the crypto world, but with no central authority controlling them. Examples include Uniswap and SushiSwap. To summarize, DeFi is the new frontier in finance, aiming to democratize the financial systems by eliminating intermediaries. Altcoins provide the diversity and options in the crypto world that Bitcoin can't. The future of DeFi is promising, with endless possibilities and challenges, and DeFi exchanges are the platforms where you can trade or lend your cryptocurrencies in a decentralized manner. Now, we hope this journey has helped you understand these fascinating concepts a little better. Remember, the world of crypto is vast and ever-evolving, so stay curious, stay informed, and keep exploring.
Ever wondered what CEX Exchange is and what it does? Well, you're in the right place. Today, we're going to unravel the mystery that is the CEX Exchange. This digital platform is more than just a place to buy and sell cryptocurrencies. It's an entire ecosystem filled with opportunities and potential risks that every crypto enthusiast should know about. Throughout this video, we'll delve into the nitty-gritty of CEX Exchange, breaking down its functionality, its advantages, and even its potential pitfalls. We'll answer questions like, what exactly is CEX Exchange? And how does it work? By the end of this video, you'll have a comprehensive understanding of this complex platform, and you'll be well equipped to navigate its waters. Whether you're a seasoned crypto trader or a newbie just dipping your toes into the crypto pool, this video is your guide to understanding CEX Exchange. So, buckle up and stay tuned as we dive into the world of CEX Exchange. So you might ask, what is a CEX Exchange? CEX, standing for Centralized Exchange, is a pivotal player in the realm of cryptocurrency. It's a type of cryptocurrency exchange where the platform's operator serves as a middleman for all transactions. This concept may sound familiar as it mirrors traditional financial systems, where banks or other financial institutions facilitate transactions. The birth of the CEX exchange dates back to the early days of cryptocurrency. It came into existence to cater to the need for a platform where digital currencies could be traded easily and securely. The CEX exchange has since become a cornerstone of the crypto world. Now let's delve a little deeper into what a CEX exchange does. In essence, it's a marketplace for buying, selling, and trading cryptocurrencies. Users deposit their funds onto the platform, and the exchange becomes the custodian of these assets. When you decide to make a trade, the CEX exchange matches your order with another user who's willing to take the other side of the deal. The exchange then ensures the transaction is carried out smoothly, securely, and quickly. The basic concept of a CEX exchange revolves around centralization. Unlike its counterpart, the decentralized exchange or DEX, a CEX exchange is run by a company that oversees all operations. It's this central entity that keeps track of all transactions, maintains the platform's security, and ensures users can easily access their assets. This centralized structure provides a sense of familiarity and trust for many users, especially those new to the crypto space. A CEX exchange also provides a range of services beyond just trading. Many offer additional features like futures trading, margin trading, and lending services. Some even provide educational resources to help users better understand the complex world of cryptocurrency. In the fast-paced, ever-evolving world of cryptocurrency, understanding the role and functionality of a CEX exchange is vital. It's not just about knowing where to buy your first Bitcoin or how to trade your Ether. It's about understanding the backbone of the crypto trading infrastructure. Understanding the concept of CEX exchange is crucial in the crypto space. Now that we know what CEX exchange is, let's move on to how it works. A CEX, or centralized exchange, is similar to a traditional stock exchange, but instead of trading stocks, you're trading cryptocurrencies. It's a platform where buyers and sellers come together to trade cryptocurrencies based on the current market price. Picture this. You're interested in purchasing some Bitcoin. How do you go about it? Well, it's as simple as creating an account on the CEX exchange, depositing your traditional currency, and using it to buy Bitcoin. You'll find a variety of cryptocurrencies available for purchase, from the well-known Bitcoin and Ethereum to the lesser-known altcoins. The process of buying and selling on a CEX exchange is straightforward. You place a buy or sell order, specifying the type of cryptocurrency you wish to trade, the amount, and the price you're willing to pay or accept. Once your order matches with another trader's, the exchange completes the transaction. But how does the exchange make money? Through transaction fees, of course. Every time a trade is executed, the exchange charges a small fee. This fee is usually a percentage of the transaction and varies depending on the exchange. One of the key roles of a CEX exchange is to act as a middleman. It's the exchange's responsibility to ensure that transactions are completed successfully and securely. They handle all the technical aspects of the trade, from matching orders to transferring ownership of the cryptocurrency. Now you may be wondering, why can't buyers and sellers trade directly with each other? Well, that's where the beauty of a CX exchange comes in. By centralizing the transactions, the exchange provides a more efficient and streamlined trading process. It eliminates the need for buyers and sellers to find each other, which can be a time-consuming and complicated process. Moreover, it provides a secure platform for trading, with measures in place to protect against fraud and hacking. In addition to providing a platform for trading, CEX exchanges also offer other services. These may include wallet services where you can store your cryptocurrencies and advanced trading features such as futures and margin trading. In summary, a CEX exchange is more than just a platform for trading cryptocurrencies. It's a facilitator, ensuring that transactions are completed efficiently and securely. It's a protector, safeguarding your cryptocurrencies against potential threats. And it's a service provider, offering additional features to enhance your trading experience. So, whether you're a seasoned trader or a newbie in the world of cryptocurrencies, a CEX exchange is a tool that can help you navigate the volatile and exciting world of digital currencies. CEX exchanges play an important role in facilitating cryptocurrency transactions, and now you know just how they do it. Up next, we'll delve into the advantages of using a CEX exchange. Stay tuned. You might be wondering, why should I use a CEX exchange? Well, there are plenty of reasons, and we'll dive into a few important ones. One of the main advantages of using a centralized exchange, or CX, is the security it offers. While it is true that no system is entirely immune from hacks or breaches, CEX exchanges are known to invest heavily in security measures. They employ sophisticated encryption technologies and often store a majority of their funds in offline, cold storage wallets. This significantly reduces the risk of your precious crypto assets falling into the wrong hands. But security is just the tip of the iceberg. Another advantage of CEX exchanges is their user-friendly interfaces. If you're a newcomer to the crypto world, you'll appreciate the intuitive designs of most CEX platforms. They are, by design, straightforward and easy to navigate, making buying, selling, and trading cryptocurrencies a breeze. With plenty of helpful resources and customer support available, you can learn the ropes quickly and start your crypto journey with confidence. Now let's talk about liquidity. CEX exchanges typically have high liquidity, which means there are enough buyers and sellers at any given time. High liquidity ensures that you can execute trades quickly and at a fair market price. This is particularly important if you're dealing with large volumes of crypto. Nobody wants to be stuck unable to buy or sell their assets because of low liquidity. One of the most significant advantages of CEX exchanges is the ability to use fiat currency. Unlike decentralized exchanges or DEX, which only allow crypto-to-crypto transactions, CEX exchanges let you buy cryptocurrencies directly with your traditional fiat money. This feature is especially beneficial for those who are just dipping their toes into the crypto pool and don't yet own any digital assets. Furthermore, CEX exchanges provide a wide array of services and features beyond just buying and selling. Many offer futures trading, margin trading, staking, lending, and even savings accounts where you can earn interest on your crypto holdings. These additional services can provide opportunities for diversification and increased returns on your investment. Finally, CEX exchanges are regulated by financial authorities, providing an additional layer of security and trust. This regulation means they must comply with laws and regulations, including Know Your Customer, KYC, and anti-money laundering, AML procedures. This regulatory oversight can provide peace of mind, especially for those who are cautious about the often Wild West nature of the crypto world. So, to sum up, CEX exchanges offer security, user-friendliness, high liquidity, the ability to use fiat currency, a wide array of services, and regulatory oversight. These features make them an attractive option for both novices and seasoned crypto enthusiasts alike. With these advantages, CEX exchanges attract a wide range of crypto enthusiasts. However, like anything in life, CEX exchange comes with its own set of risks. Let's dive into some of the potential risks that you might encounter while using a CEX exchange. One of the most significant risks is hacking. In a centralized exchange, user information and funds are stored in a centralized server. This makes it an appealing target for hackers. If a hacker were to gain access to the server, they could potentially steal all the funds stored there. A notable example of this is the infamous Mt. Gox hack, where approximately $450 million worth of Bitcoin was stolen. The risk of hacking is not something to be taken lightly. While exchanges do their best to secure their platforms, it's a never-ending battle against increasingly sophisticated hacking techniques. Therefore, it's crucial to remember that when your assets are stored on a centralized exchange, you're essentially entrusting the security of your funds to that exchange. The second key risk is the issue of centralization itself. In a CEX, a single entity has control over the operation of the exchange. This means that decisions regarding the exchange are made by a small group of individuals, which may lead to decisions that are not in the best interest of all users. For instance, the exchange could decide to delist a certain cryptocurrency without any prior notice, causing a significant impact on traders holding that particular crypto. Moreover, centralization also means that if the exchange were to go bankrupt or shut down for any reason, users could potentially lose access to their assets. This is a stark contrast to decentralized exchanges, where users retain control over their assets at all times. The third risk involves regulatory issues. Cryptocurrency regulation varies widely from country to country, and in some cases it's still a gray area. This means that a CEX could potentially face legal issues that might affect its operation. For example, an exchange could be forced to cease operations in a certain country due to regulatory changes, leaving users in that country with limited options to withdraw or trade their assets. Finally, it's worth noting that while CEX often offer insurance on user funds, this insurance may not cover all scenarios. For instance, if a user falls victim to a phishing attack, the loss of their funds may not be covered by the exchange's insurance policy. In conclusion, while CEX exchanges offer many advantages, they're not without their potential pitfalls. It's important to be aware of these risks and take appropriate measures to safeguard your assets. Always do your research before choosing an exchange, and consider diversifying your holdings across different platforms to mitigate potential risks. Being aware of these risks can help you make informed decisions in your crypto journey. So, we've covered quite a bit about CEX exchange, haven't we? Let's take a moment to pull all those threads together, to summarize the key points we've discussed, and to paint a comprehensive picture of what CEX exchange really is. We started out by defining CEX exchange. It's an online platform that operates as a conventional marketplace for buying and selling cryptocurrencies. This is the place where you can exchange your conventional money, like dollars or euros, for digital currencies like Bitcoin or Ethereum, and vice versa. The term CEX stands for Centralized Exchange, which means it is a third-party platform that facilitates the transaction between buyers and sellers. Next, we dug deeper into how CEX exchange works. It functions much like a traditional stock exchange, but with cryptocurrencies. When you want to buy or sell a cryptocurrency, you place an order on the CEX exchange. This order then gets matched with an opposite order and the transaction is completed. It's as simple as that. And because it's centralized, the CEX exchange handles all the technical aspects of the trade, making your life a whole lot easier. We then looked into the advantages of using a CEX exchange. The first and foremost is its user-friendliness. The platforms are designed to be intuitive and easy to navigate, even for newcomers. CEX exchanges also offer a wide range of cryptocurrencies to trade, giving you the freedom to diversify your portfolio. And let's not forget about the high liquidity, which ensures that you can buy or sell cryptocurrencies quickly and at a fair market price. But as with everything in life, CEX exchanges aren't without their risks. We discussed how, because they are centralized, they become attractive targets for hackers. And if a CEX exchange gets hacked, there's a chance you might lose your digital assets. We also talked about the regulatory risks. Because CEX exchanges operate in a legal gray area in many countries, there's always a risk of sudden regulatory changes that could affect your trading activities. So there you have it. A CEX exchange is a centralized platform where you can trade cryptocurrencies. It's user-friendly, offers a wide range of digital currencies, and provides high liquidity. But it's also prone to hacking and regulatory risks. It's a tool that, when used wisely, can be a powerful ally in your crypto journey. Remember, knowledge is power. The more you know about CEX exchanges, the better equipped you'll be in the crypto world. Thank you for joining us today.
Welcome, crypto enthusiasts and curious minds around the globe. Today, we're venturing into the fascinating realm of cryptocurrency exchanges. These platforms, whether you're a seasoned trader or a crypto newbie, play a fundamental role in the world of digital currencies. They're the bustling marketplaces where all the buying, selling, and trading happens. But did you know that not all exchanges are created equal? There are two main types of exchanges that dominate the crypto landscape: centralized exchanges, also known as CEX, and decentralized exchanges, or DEX. They're different beasts entirely, each with their own unique characteristics and advantages. But what exactly sets them apart? Ever wondered what the differences between CEX and DEX exchanges are? Well, you're in luck, because that's the million-dollar question we're going to answer today. So grab your digital notepads, because it's about to get interesting. Stay tuned as we delve into the nitty-gritty of CEX and DEX exchanges. First off, let's take a closer look at CEX, or centralized exchanges. As the name suggests, these are platforms where cryptocurrency transactions are managed by a centralized authority. Think of it as a traditional bank, but for digital assets. In the world of cryptocurrencies, CX exchanges are like the big city skyscrapers, towering and commanding attention. They are the most common type of cryptocurrency exchanges, and they've been around for a while. They operate on a principle that's as old as commerce itself: a middleman, or in this case, a third-party authority that facilitates transactions between buyers and sellers. At the heart of a CEX exchange is a company or organization that oversees operations. They set the rules, they manage the transactions, and they provide the infrastructure. It's their platform, their playground, and users are essentially guests. They provide the convenience, the safety nets, and of course, the regulatory compliance. In return, they charge fees for their services. In essence, CEX exchanges are intermediaries that ensure the smooth operation of trading activities. They handle everything from order matching to executing trades, and even offer additional services like wallet storage and fiat to crypto conversions. This centralized management provides a certain level of trust and security for users. One of the key features of CEX exchanges is the involvement of a third-party authority. This authority is responsible for maintaining the platform's integrity, ensuring that all transactions are legitimate and that all users abide by the rules. This, in many ways, is similar to how traditional banks operate. Now let's talk about some examples. Some of the most popular CEX exchanges include the likes of Binance, Coinbase, and Kraken. These platforms have grown significantly over the years, serving millions of customers worldwide. They've become household names in the crypto world, synonymous with cryptocurrency trading. These exchanges offer a wide range of cryptocurrencies for trading, from the well-known Bitcoin and Ethereum to the lesser-known altcoins. Moreover, they provide a user-friendly interface, making it easier for both beginners and experienced traders to navigate the crypto market. But it's not all sunshine and rainbows. Centralized exchanges have their own set of challenges. They can be vulnerable to hacking attempts due to their centralized nature. Moreover, they are subject to regulatory scrutiny, which can sometimes lead to sudden changes in trading policies, causing inconvenience to users. Regardless of these challenges, CEX exchanges continue to dominate the crypto trading landscape. Their ease of use, security measures, and wide range of offerings make them an attractive option for many. That's the gist of CEX exchanges. But how do they compare to their counterpart, DEX? Now, it's time to turn our attention to DEX, or decentralized exchanges. Moving away from the centralized model, we enter the realm of the decentralized, a world where middlemen are obsolete and users hold the reins. Decentralized exchanges, often abbreviated as DEX, are platforms that operate without a central authority. They allow for direct, peer-to-peer cryptocurrency transactions to take place online securely and without the need for an intermediary. What makes DEX exchanges stand out is their reliance on blockchain technology, specifically smart contracts, to facilitate and automate the trading process. In essence, smart contracts are self-executing contracts with the terms of the agreement between buyer and seller directly written into lines of code. Because these contracts live on the blockchain, they're transparent, traceable, and irreversible, ensuring that all transactions are secure, and trustworthy. One might wonder, how does this all work without a third party? Well, when you place a trade on a DEX, you're not sending your assets to the exchange to hold while the trade is made. Instead, the trade happens directly between your wallet and the wallet of the person you're trading with, all facilitated by smart contracts. This means you maintain control of your assets until the exact moment the trade is completed. Now let's touch on some well-known DEX platforms. Uniswap, for instance, is one of the most recognized decentralized exchanges. It operates on the Ethereum blockchain and uses an automated liquidity protocol. Another popular platform is SushiSwap, a decentralized exchange also built on Ethereum, offering a platform for swapping, staking, lending, and borrowing digital assets. Then there's PancakeSwap, a Binance Smart Chain-based DEX, with a focus on providing users with a fast and affordable trading experience. And let's not forget about Curve Finance, a DEX optimized for stablecoin trading, offering low slippage and low fees. DEX exchanges give users the power to control their assets, provide increased privacy, and offer a way to participate in the growing DeFi or decentralized finance movement. However, they're not without their challenges. The reliance on smart contracts means that any bugs or vulnerabilities in the contract code can lead to significant losses. Also, the lack of a central authority may deter those who prefer the security of a regulated entity. So that gives you an idea of what DEX exchanges are. But how do they stack up against CEX? Now that we've unpacked both CEX and DEX, it's time to compare them side by side. Both types of exchanges have their own distinctive characteristics, each with its own set of advantages and disadvantages. Let's dive in. Firstly, let's talk about user control. With centralized exchanges, or CEX, the exchange holds your funds. You're essentially entrusting your assets to the exchange. On the flip side, decentralized exchanges, or DEX, give you complete control over your assets. You hold your own private keys, giving you full custody of your funds. This autonomy can be empowering, but it also means you bear the responsibility for the security of your assets. Next, let's consider security. CEX exchanges are generally considered to be more prone to hacking. They're centralized entities, which means they're attractive targets for hackers. Remember, when you're dealing with a CEX, your assets are held by the exchange. If the exchange gets hacked, your assets are at risk. On the other hand, DEX exchanges are decentralized and operate on blockchain technology, which is inherently more secure. However, this doesn't mean they're immune to all types of attacks. They can still be vulnerable to certain exploits like smart contract bugs. Now on to privacy. With a CEX, you generally need to go through a verification process called Know Your Customer, or KYC. This means you'll have to provide personal information, which could potentially be exposed in the event of a data breach. On the contrary, DEX exchanges typically don't require KYC, offering a higher level of privacy. But remember, transactions on the blockchain can still be traced, so it's not absolute anonymity. Speed is another factor to consider. CEX exchanges are generally faster when it comes to trades. They use order books, and transactions are not dependent on blockchain confirmations. DEX exchanges, however, rely on the speed of the blockchain they're built on. This can lead to slower transaction times, especially when the network is congested. Next up, liquidity. CEX exchanges usually have higher liquidity. This means it's easier to buy and sell assets without affecting the market price too much. DEX exchanges, while growing in popularity, still generally have lower liquidity. This could potentially lead to price slippage, which is when the executed price of a trade is different from the expected price. Lastly, let's discuss user experience. CEX exchanges are often more user-friendly. They offer customer support and typically have more intuitive interfaces, making them more accessible to beginners. However, DEX exchanges can be more complex and require a bit more technical knowledge. But for those who value decentralization and autonomy, the learning curve may be worth it. As you can see, both CEX and DEX have their unique strengths and weaknesses, depending on your individual needs and preferences. CEX exchanges might be a better fit for those who value convenience, speed, and customer support. On the other hand, DEX exchanges could be more appealing to those who prioritize control, privacy, and the principles of decentralization. It's all about finding the right balance that suits your trading style and comfort level. Remember, the crypto world is ever evolving, and so are these exchanges. So, stay informed and make the choice that's right for you. With all that said, what are the key differences between CEX and DEX exchanges? First off, let's talk about control. Centralized exchanges, or CEXs, are controlled by a single entity. They're the ones who hold your funds, process your trades, and ensure everything runs smoothly. On the flip side, decentralized exchanges, or DEX, are run by the community. There's no central authority, so you maintain full control over your funds. This leads us to the next difference: trust. With a CEX, you're putting your faith in the exchange to keep your assets safe. They're responsible for security, and if something goes wrong, it's on them. But with a DEX, the responsibility falls on your shoulders. There's no middleman to rely on. If you lose your private key or become a victim of a phishing attack, there's no customer support to turn to. Thirdly, we have privacy. CEXs typically require you to provide personal information to comply with regulations, a process known as Know Your Customer, or KYC. This can feel intrusive to some, and there's always the risk of data breaches. DEXs, by contrast, offer a higher degree of privacy. There's no need to reveal your identity, and your transactions are only visible on the blockchain. Then there's the matter of speed and liquidity. CEXs generally offer faster transaction times due to their centralized nature. They also tend to have higher liquidity, meaning there's more trading activity and it's easier to buy and sell assets. DEXs, while improving, can't quite match up yet. Transactions can take longer due to the nature of blockchain technology, and liquidity can be lower. Finally, we come to features and user experience. CEXs often provide a more user-friendly interface with advanced trading features like margin trading and futures contracts. Some even offer insurance on deposits. DEXs, meanwhile, are more bare bones. They focus on the core functionality of swapping assets. However, the landscape is changing rapidly, and many DEX are now incorporating more advanced features. But it's not all black and white. The crypto world is ever evolving, with new concepts like hybrid exchanges that combine elements of both CEXs and DEXs. The best of both worlds, you could say. To wrap up, the choice between a CEX and a DEX comes down to a trade-off. Are you willing to sacrifice some control and privacy for the sake of convenience and advanced features? Or do you prefer to keep full control over your assets, accepting the added responsibility that comes with it? There you have it, a comprehensive look at CEX and DEX exchanges. Remember, the right choice depends on your specific needs and risk tolerance. Until next time, keep exploring the vast universe of cryptocurrencies.